Guys, welcome back to the channel. You know I don't do any of this hindsight rubbish where I post trades that only do well. I only post foresight trades, and in this video I'm going to share with you a massive opportunity on the dollar yen. There hasn't been an opportunity like this in 30 years, so this is potentially a once in a lifetime opportunity, and I'm going to break down exactly what I'm looking at, how I'm looking to get involved, so that you can follow along and actually learn something and apply it to your trading immediately. So let's get stuck in. So let's take a look at the dollar yen first. What I'm gonna do is I'm gonna go out to the weekly first of all. Now, one of the things I like about this already, I'm looking at what's happening, and I'm reading the tape, as it were, looking at price movement live, but I'm not excited about the rejection candle. What I'm more interested in is this big bullish run, right? Big bullish run. First of all, I see that, and I know that that doesn't go on forever. Now, the second thing that you need to know is I'm looking at a bullish run, and I'm using that to my advantage, and I'm excited about that because that's already completed. The rejection candle hasn't completed, so it's not a rejection candle. I don't class anything or label anything until it's completed. So this candle may just rally to the upside, and then on Friday night close out and it's another bullish candle. Does that make sense? So it's not a high test wick, so don't label it a high test wick until it is. You get into that, if you get into that trap, you're going to start taking low quality setups. So this is about seeing what has happened, and there's nothing wrong with seeing what is in play, but that hasn't happened. Does that make sense? So it's not a confirmation, so it can't form a bias into your trade. So first thing that is interesting to me is a big bullish run, right? 1, 2, 3, 4, 5, 6, 7 bullish candles, big momentum candle last week as we pushed up into that 158 level. Now what I'm going to do is I'm going to go left, and I'm going to look at previous structure. Okay, look at this, right? Now you guys can see this. I'm going to scrunch this right up so you can see it. Look at this. Now, if I bring on my rectangle tool, this here was April 1990. This level here was April 1990, and that was the last time this was tested. 1990, 34 years ago, we tested this level, and that was the last time this price was tested. Do you think that has some significance? The next nice little observation here is it was from 158, which was really the start or the open of this candle here, to 158 to 160. So there's a 200 pip window, right, which is for a yen pair, and over that period of time, that's a pretty shallow window, right? So we've got that. So now we've drawn that on, we can now go out to today's date, and we can start looking at some confluence factors to give us some confirmation, some confidence that there's likely to be a reaction at this level. Well, the first things first is look at that. We rallied all the way up to there, hit that level like a brick wall. We closed right at that zone. This is 1990 to today, 34 years. We haven't been at 158 for 34 years. So now, higher time frame, we know we're in a major level of resistance, and resistance meaning there is a high probability that there will be another rejection or a reaction or a hold of that level. Okay, so one thing, what don't I want to do here? What am I not looking at when I'm approaching this market now? Buying opportunities are completely abolished from the thing. I'm not even thinking about buying opportunities. I'm not thinking about long opportunities, even though I'm not on my trading time frame yet. When I go to my trading time frame, I will not be looking for buying opportunities. This is the beauty of having a IPDE process: identify, predict, decide, execute. The identify phase, which is the first phase, is what we're doing now, and basically what we're doing is we're forming a bias. We're forming a thesis, a prediction. So we're looking at the overall, like the bird's eye view, a higher time frame, the macro, and we're going, right, are we likely to go long or short? Are we likely to go up or down? That's it. where is market likely to go next, and how is market likely to get there? And that's it. And once we form that bias and we say, right, it's a long or a short, in this case, not a long, potentially a short, we're only looking for shorts. We're not looking for longs. We're definitely not looking for buying opportunities. Okay. Now, most people, when they see this type of move, they get excited, like the Bitcoiners, and the first thing they think to do is to buy, because they see the run and they go, oh, look, it's going up and up and up. I need to get in. I need to buy this. I'm thinking the total opposite because of this technical analysis that we're performing here, right? So now we can go down to the actual trading time frame. Before I do that, I'm just going to go down to my first swing trading time frame, which is the daily. Now, there's not much that's going to give us extra confirmation here. We're just seeing that rejection, right? And we saw that indecision. If I zoom in here, this is another signal that plays into our prediction. This is like a tug of war. See this? If I just bring on my arrows, what you can see is we opened here. We opened up at 157.87. The bulls pushed up, right? And then the bears pushed down. And then we ended up back in the middle and we closed here. So if you imagine a tug of war, it tells a story of who's, what's happening during that session. Bearing in mind, this was an entire day. But it also tells us the story of who was doing what and who had the most influence, who had the most power. So if you look at this wick here to the upside, right, that is a 230 pip wick. And if you look at this to the downside, it's a 175 pip wick, but we also closed lower as well, right? So it's a bearish candle overall. So it also tells you the kind of power between that tug of war. Now, that really doesn't tell us that much, but what it does tell us is we had this big bullish run into a major level of resistance. 34 years ago was the last time we tested this high. And following that big bullish run, there has been some indecision. It was undecided at this point who was going to win this tug of war. It was just a even, right? It was a draw. So now we go down to the trading time frame and we look for our trading setups. Now, for me, what I would look for here is a retest. Now, with the dollar yen, you have to be a bit more aggressive than you do on some of the other pairs. So some of you might have just entered this this 3-bar reversal, this reversal candle here, right? But those of you who need a bit more confirmation, because bearing in mind, this is going to be if this plays out, it could be a big reversal. It could be a really big reversal, meaning you can catch a lot of profit. You can trail your stops. You can just trail this thing down for the next 20 years, right? Not that you're going to do that as a trader, but you get the point. So now look, we're looking. This is the major structure zone that we drew out. This red rectangle. We even on the 4-hour time frame, we have respected that. Look at that. Bang, bang, bang. Big rejection to the upside. We closed down here, right? So it's really respected. If we get another test of this high, this will be a perfect double top. Let me explain why. Look at the other confluence factors we got here. Look at this RSI. RSI is a volume indicator, and it measures the transactional speed of a particular asset, right? Now, I always give the example of like Justin Bieber tickets. Concerts announced. Justin Bieber announces a concert. The tickets go on sale Friday, and boom, the line's open, right? And the speed of the transactions at 9 a.m. very, very fast, right? And the best seats and the best seats and the best seats. And as the minutes go by, the speed of those transactions starts to slow down, okay? The RSI relative strength index is a volume of transactions. So conventionally, it's between 0 and 100, right? And 30 and 70. 30 is considered conventionally oversold, and 70 is considered overbought. Now, I like to, because I use the RSI as confluence factors into a trade decision, into a setup, what I use it for is extreme measures. So I like to look at the 20 and the 80. So when we approach previous structure like this, and we've got major structure looking left, and we've got 34-year-old major high, weekly high, and we've got all of these other these clues that tell us that we're likely to see a rollover here. When I see RSI above 80, that is a great a great addition to my case for entry. Now, not only are we over 80, we're at about 94.5, 95. So if we do put in a double top here, and I'll explain what I'm looking for in just a second. If we do put in a double top, and bear in mind this is the dollar yen, we may not put in a double top. You have to be quite aggressive on this pair. It could just roll over. But if we do put in a double top, what we would have here, hopefully, is some really strong bearish divergence. You see that? What divergence means is when the price is doing one thing and the RSI or the stochastic is doing the opposite. So you'll have higher highs or equal highs on price, and you'll have lower highs on the RSI. So if you're overbought on the RSI, sorry, and then if you're overbought on the RSI and then you have another top on price, which matches the first test, but you have divergence on that RSI, meaning that the RSI is now back into a normal condition, that gives you some RSI divergence. And whenever you have that divergence, there is a high probability that the play will reverse. Okay. There's also RSI convergence, which is the opposite. So if you're looking at a trend and the RSI is mirroring price, that means that the trend is likely to continue. But when you see a divergence, it means the opposite. It means that there's a discrepancy. So that's what we're looking at, a double top here. Now the 4-hour time frame would be good, be great. That's where I would look for a double top on this. And let's talk about the rules for the double top. So the second test has to test the initial test, but not break and close above the initial high. Okay, so let's just draw this on. It has to test this high, right? But it cannot close above that high. So what does that look like? It looks like this. Let me bring on a rectangle. I'm first of all just going to draw this in green. Is this making sense to everyone? Good setup. This is the juiciest one on the radar. That's why I'm spending so long on it. And I think you guys said that you're enjoying these more deep dives on one setup anyway. So here's what it has to do. Let me just bring on a wick as well. So we need to test this high, but not break and close above it. So if it does something like this, that's great. If it does something like this, that's actually still a valid setup. If it does something like this, that's still a valid setup. If it does something like this, that's still a valid setup, right? So it has to actually test the start of this red zone, but not close above the red zone. And that's it. And as soon as we get that, the rules of that double top are met. And then once that candle is closed, whatever candle does it, now remember, you have to wait for that to close. That's important, because if you don't wait for it to close, then you could do this. And then you're in an invalid setup. This is actually called a new high, a new structure high. And then the bias completely changes. It's now, we're likely to push up higher, right? So then you go back to the IPDE, completely eradicate all of your selling opportunities, and you go, right, I'm looking for a buying opportunity now. Because remember, this is the major high from 1990. If we close above that, then the opposite. We're likely to see that as become a really strong level of support and potential rally to the upside. So you have to wait for it to close. And if we close and we've tested the previous high and haven't closed above it, that's a valid double top. And then we've got the divergence on the RSI. Great, good to go. Next bar market orders. And what next bar market orders are where you place the order on the open of the next candle. So you wait for the candle to close. If this is the 4-hour time frame, whatever time that is in where you live, whenever that 4-hour time frame closes, you wait for that to close. On the open of the next candle, you place an at market order. So you have to actually be in front of the charts to place that order. Does that make sense? And that's an at market order. And the way you do that, like if you're just for an example here, you would just create a new order and you would come on and it would be a market order. This one here, market order. And then you'd hit sell, calculate your position size, which you can, whatever you want to, whether you do a fixed position size or a percentage risk, whatever that might be, 2 mini lots, and then you just hit sell. So we're not going to do that just yet, but this is definitely a trade that I'm looking to get into. So we'll keep an eye on this one, and hopefully we can get this one going. We'll get into this one. But let's talk about target taking. So let's go out to the daily time frame. I'm looking at the daily time frame for potential targets. Now look at this. Another great thing is this is really where you don't want to fight below. Okay, so in terms of target taking, you don't want to push through all of this. As a trader, you're not being greedy. You just want the sure thing move. You want to get in and out and the highest probability move as possible, and you want to take your money. Okay, and you want to make sure that the reward to risk profile is in your favor. So looking left, look at this 150 level, this 151 level, October 22, November 23, November 23, March 24. We held that level multiple times. If I just bring on an arrow here, you see that big rejection there, double top there, pregnant pause there. Okay, so we've got another level of major resistance at 152. So if you're looking to take targets, you don't want to fight through that. You don't want to fight through that. You want the path of least resistance to your target and the path of most resistance to your stop loss. So if your stop loss is above that major high, that's great. Target can be above this, so that you don't have to fight through that, and you're still getting a 3-to-1. A very high probability setup.
All right, the last thing, before we wrap up on this, the last piece of confluence that I want to look at is the seasonality using Forecaster. You guys have seen me use Forecaster before. It's an incredible tool. And I can already see that just on this chart here, you can see there's this down move, right? Now let's go out and look at the last 5 years, 10 years, 20 years, heck, let's just look at 30 years. And what I'm going to do is I'm going to draw on this little zone here, right, which is from the 30th, which is today, until next, like the 5th, okay, 5th of May. So the next 5 days. And this is obviously a very, foresight trade and opportunity. This is right now. I don't post hindsight rubbish. And as you're going to see, if we click on short, there is 100% shorting over the last 5 years, 70% 10 years, 55%, right? There is a way above average shorting opportunity here with the confluence across 30 years, 20 years, 10 years, 5 years. Now, if we go to the weekly average, you can see that today there is 100% short over the last 5 years. But all of these across today and tomorrow is where this opportunity, according to Forecaster, is going to be the most prolific. So this is what I've got my eyes on for the next day or so. You guys follow along and we'll see where this goes. All right, so let me know what you're looking at. Let me know how you would approach this, and also follow along from today and keep in the comments to see what happens and what doesn't happen. Share your thoughts of what you're thinking as the trade plays out.
If you enjoyed the video, please give it a thumbs up. Now, subscribe to the channel for more like this, and in the description you'll find all the links to the things that I use if you're looking for platforms or tools. And until next time, take care, have a great rest of your day, be careful in the markets, and I'll see you then.